I thought I was investing, but really, I was just setting myself up to fail. 3 months in, I was already panicking. I'd lost money, pulled out too early, and realized I didn't even have an emergency fund. No checklist, no patience, and worse, I was still in debt and I was paying around 29% interest. These weren't just mistakes, they were expensive lessons. Let me show you the 5 rookie errors that I made so you don't lose money the way that I did. Hello there, I'm the Value Investor. I teach people how to save and invest intelligently. So, the first mistake that I was making constantly was short term thinking. And short term thinking sometimes was because of circumstances and things that were happening around me that I wasn't really prepared for. So let me paint you the picture. So I was chasing short-term gains. So I was in and out in about 3 to 6 months max. Now that's not investing, that's speculating, because investing you need to give yourself 5 or more years to actually see your investment compound and make significant gains. If you're investing for shorter than that, if you're hit by a bear market, for example, some bear markets take 10 years to actually resolve and get you to start making money. So, Seth Klarman, who is a super investor that I aspire to, actually says patience is one of the greatest edge of the investor. This short-term thinking was caused by other things that I'm going to explain later on in the video. Stick around until the end of the video to find out what was causing this short-term thinking. Mistake number 2, I did not have an emergency fund. So an emergency fund, these are 3 to 6 months expenses that you keep in cash. And the reason why you do that is so that you do not find yourself falling trap to mistake number 1. So an emergency fund cushions you, it protects you if life happens. So I'll give you an example. I would invest my money, is there in the stock market. Maybe I have a very sizable port, maybe 10,000, but I don't have an emergency fund. So if I lost a family member back home in Zimbabwe, I would have to sell some of my shares to get on the plane to go to the funeral. So you see what I'm saying? You need to have an emergency fund which you can pull out of if life happens. If your boiler breaks down, you don't want to be selling your shares to go and replace that boiler. You don't want to be selling your shares because your car is broken down. Sometimes what actually happens is that when those things happen, the stock market would have gone down 10%, and you don't want to be selling your shares whilst you are in a loss, because when you do that, that's permanent loss of capital, and you don't want that. That's the real risk in investing, permanently losing your capital. So the lesson that I've learned from that is invest after you've built that cushion. So the third mistake that I made was that I didn't have a checklist. So a checklist is a list of things that you need to check before you actually pull the trigger. And this is very, very important, especially for pilots. Pilots have to go through a rigorous checklist before they take off. If they don't do that, they can miss something which can be the difference between life and death. Because if a plane crashes, soon as it takes off, that's the chances of people surviving there are very, very low. So I would buy stocks based on vibes, not valuation. As of now, I never buy a stock without going through a checklist. And if you want to get hold of the checklist that I use to buy stocks, you can go and download that on my website. I'll put the link down in the description below. So now I don't buy stocks without going through this checklist first to check if they match up, and then I pull the trigger. So this checklist, I've developed it from the mistakes that other people have made and from some of the things that I've learned from Warren Buffett. Mistake number 4 is temperament, and I think this one is one of the most common mistakes that I've seen other people make as well. Now, temperament is very, very important. You can have the maths, you can be a genius, you can actually pick out stocks that are trading at a discount, the really cheap stocks, you can pick them out like that because you're good at maths. But if you cannot hold in a bear market, if you can't hold because the stock market has gone down 10%, then you might as well be like the rest of us who are not very good at maths. So what did I do? I would panic in bear markets. I would sell my stocks at a very low price because I was panicking. So the best investors, they don't just know the maths, they control their emotions. And investors like Seth Klarman and Warren Buffett, they stress this point that investing is not just about the maths. It's not just about picking winner stocks. It's about being able to hold them for longer than everyone else, because the stock market is a place where the wealth is transferred from the impatient to the patient. So if you are patient, you're already far ahead of most of the investors. And then mistake number 5, and this mistake cost me quite a lot because I was keeping a lot of debt. So if you invest when you are in debt, especially credit card debt, you are compounding negatively. Now, let me explain what I mean when I say compounding negatively. So I was paying 29% on credit card debt, and I was investing and getting around 15 to 20% a year. So in effect, I was losing 10 to 15% every year because that credit card debt, it was quite a lot. Investing in stocks whilst I had this debt, it wasn't smart at all. So Warren Buffett says, pay down your credit card first. Paying off my credit card for me was actually making 29% return. So these are some of the things that I've learned, and I do not want you to make the same mistakes that I did. So I made this short video to tell you my downfalls so that you don't have to make them. So these weren't just fun lessons, they were necessary. Investing rewards discipline, not desperation. What's the biggest investing lesson that you have learned? Let me know down in the comments below. Let's discuss. Maybe I can learn something from you. Now, this is the Value Investor here, signing out. See you in the next one.